Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Jeju CRRC Times Electric Co. Limited annual report. Jeju CRRC Times Electric Co. Limited offers a diverse range of businesses and services that cater to various industries. At the core of its operations are propulsion and control systems for urban rail vehicles, including traction converter systems, power supply systems, and braking systems. The company also provides informationization and intelligent system products, test equipment, and communication and signaling systems. In addition, it offers electromechanical system integration services that combine electrical, mechanical, and software components to create comprehensive solutions. In the realm of rail maintenance and engineering, Jeju CRRC Times Electric Co. Limited supplies a variety of products such as heavy-duty motor trolleys, OCS operating vehicles, and large track maintenance machinery. Its line maintenance services include electrical system installation and infrastructure inspection and monitoring systems. Furthermore, the company has expanded into new energy sectors by offering wind power inverters, PV inverters, storage systems, and hydrogen power supply solutions. It also provides industrial and component products like industrial electrified products, electric drive systems for new energy vehicles, marine engineering equipment, power semiconductor devices, and sensors. Overall, Jeju CRRC Times Electric Co. Limited's extensive portfolio of businesses and services reflects its commitment to innovation and customer satisfaction in the global market. Jeju CRRC Times Electric Co. Limited market capitalization of 50 billion is significantly larger than the average industry peer of roughly 6 billion. This shows that Jeju CRRC Times Electric Co. Limited holds a significant advantage in their industry. Jeju CRRC Times Electric Co. Limited trades at a higher price-to-earnings ratio of 11 times and a higher price-to-book ratio of 1.04 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The company maintains a moderate leverage profile, with liabilities making up 31% of total assets, suggesting a balanced approach between risk management and capital efficiency. Liabilities have grown faster than assets and equity, which is somewhat concerning. However, asset growth remains positive, suggesting management may be temporarily leveraging liabilities to fund expansion. Shareholder equity has expanded consistently over the past 5 years, with growth supported by rising operating income. This suggests the company is profitable and financially sustainable. The company has consistently reduced its share count, while revenue and equity have grown, indicating disciplined buybacks that enhance long-term per-share value. The company have a dividend yield of 4.27%. The income statement shows that the company have been growing its revenue annually, and the operating income have been increasing. This shows that the business model works and the business is expanding. The primary drivers of revenue growth or decline for Jeju CRRC Times Electric Co. Ltd. can be identified through several key factors. Firstly, an increase in contract assets from clients such as client 103,233 and sales contracts has contributed to revenue growth. Additionally, the sale of rail transit equipment products has been a significant contributor to revenue recognition. Maintenance services have also seen an increase in some sections, while government grants have played a role in both revenue growth and decline. Changes in contract liabilities related to sales contracts and construction service contracts have been noted as factors affecting revenue growth or decline. Furthermore, fluctuations in foreign currency, exchange rates, and interest rate risk on borrowings with floating interest rates have impacted revenue. It is essential to consider these factors when analyzing the company's financial performance. However, it is also important to note that a comprehensive understanding of the primary drivers of revenue growth or decline may require further analysis and review of the company's financial statements and reports. Net income experienced a significant increase of 8.6% from 2024 to 2025, reaching 4,309,063,789. This growth can be attributed to various factors, including the company's strong performance in railway investment and construction, driven by government policies and initiatives. The The domestic market share of urban rail traction systems also contributed to this increase, as the company led the industry for 14 consecutive years. However, profit margins showed a mixed trend. Operating profit margin decreased from 17.4% in 2024 to 16.9% in 2025, while net profit margin increased from 7.9% to 8.5%. EBITDA margin also saw an increase of 15.43%. The decrease in operating profit margin can be attributed to increased competition and low-price strategies adopted by domestic competitors. The company's steady progress in overseas business, with multiple projects won in Asia, the Americas, and other regions, also contributed to its growth. Overall, the net income increase was driven by a combination of factors, including government policies, market share leadership, and international expansion. The company's financial performance indicates a consistent generation of positive operating cash flow. This can be seen in the net cash flow from operating activities, which has shown an increase of plus 17.96% compared to the same period last year. The company's ability to generate positive operating cash flow is further supported by its solid support for debt repayment and a decrease in bad debts. The numerous references throughout the document confirm that the company is indeed generating positive operating cash flow. Pages 8, 32, 36, 80, 125, 128, 132, 133, 142, 166, 169, 173, 179, 212, 254, 255, 258, and 260 all indicate a net inflow of cash from operating activities. This suggests that the company's operations are generating sufficient cash to cover its expenses and investments, resulting in a positive operating cash flow. The company's debt level and interest expenses have undergone significant changes over the past year. According to the extracted summaries, the total debt level has increased by 4.3% from CNY 1,050,766,406 to CNY 3,597,376,464. This increase is substantial, with a total debt growth of CNY 11.69 billion and CNY 36.9 billion in different periods. However, the interest expenses have shown mixed results. On one hand, some sections indicate a significant decrease in interest expenses, such as a 33% drop from RMB 39,387,935 to RMB 26,238,709. On the other hand, other sections reveal a substantial increase in interest expenses, with an 83.5% rise and an increase of CNY 837.7 million. Despite the conflicting information, it appears that the company's debt level has increased significantly, while its interest expenses have shown both decreases and increases. This mixed trend suggests that the company is facing challenges in managing its debt and interest expenses, which may impact its financial performance and stability. The performance of various segments and regions within a company has been analyzed based on extracted summaries. Unfortunately, some areas showed poor results. Hunan CRRC Signal, Shanghai CRRC SMD, Beiji CRRC Times, and Taiyuan CRRC Times all performed poorly. On the other hand, there are indications that certain segments have done well. Operating activities in Segment 1 increased by a significant 58.3%, while receipts of tax refunds in Segment 2 rose by an impressive 75.6%. However, it is worth noting that Zhejiu CRRC Times Electric Co., Limited, did not provide clear information about its performance. The China region and international region, as well as the electric locomotive segment, do not have any specific data on their performance. Overall, while some areas of the company are thriving, others require improvement to meet expectations. Management's vision for the company is centered around strategic growth and innovation. The primary goal is to align with national development strategies while leveraging core competencies to drive profitability in growing industries. This involves prioritizing innovation-led growth, quality first, and intelligent transformation. To achieve this, the company aims to expand into new markets and industries such as semiconductors, automobiles, new energy, marine, and industrial operations. A key focus area is the R&D and industrialization of traction drive and control systems. The management also emphasizes the importance of self-reliance and self-improvement in science and technology through driving industrial innovation. The company's long-term objective is to become a world-class electrical system solution provider in transportation and energy sectors, leveraging its advantages in 6 key industrial sectors. To achieve this, it will prioritize high-quality development, improve profitability through management capabilities, and optimize the industrial structure. Overall, the management strategy is centered around strategic growth, innovation, and self-reliance to drive the company's success. The company has a history of paying dividends to its shareholders. The records show that dividend payments have been made consistently over the years, with a total cash dividend for 2025 amounting to RM$520,709,169.44. In addition, the company paid out RMB10 per 10 shares in 2024 as a cash dividend. The company has also engaged in share buybacks, repurchasing a significant number of H shares in the Hong Kong stock market. A total of 44,655,500 H shares were repurchased by the company. This indicates that the company is committed to returning value to its shareholders through both dividend payments and share buybacks. There are concerns about inventory buildup in the industry. The data suggests that there has been a significant increase in inventory levels over the past year. Specifically, semiconductor device inventory rose by 15.07% from the previous year, indicating a substantial accumulation of stock. Furthermore, the total inventories increased by 58,342,068 CNY in 2025, which is a notable rise. This increase in inventory levels raises concerns about potential supply chain disruptions and inefficiencies. The buildup of raw materials and work-in-progress inventories suggests that production may be slowing down or that there are issues with the manufacturing process. The decrease in finished goods inventory is somewhat reassuring, but it does not offset the overall concern about inventory buildup. The large increase in total inventories, amounting to 322,286,117 units, indicates a significant strain on the supply chain and potential for future disruptions. That concludes the financial summary for Zhejiu CRRC Times Electric Co. Limited. Feel free to comment below, and I will be happy to answer them when possible.